I have the head research AfriInvest West Africa, Robert Omotunde, in the studio to discuss more and to actually make more sense of what these figures mean. Thank you very much for joining us.
Thank you, Tolu, for having me.
First, in more than 4 years, since 2015, we had a little bit of, what do you make of that?
Well, the last time the MPR was tweaked was in July of 2016.
Wow.
Yeah, I mean, again, we're seeing this coming after about 2 to 3 years.
3 years.
You know, that we've last seen this. Market largely did not expect this move, so it was a surprise. And coincidentally, it's coming perhaps when you're having the last MPC meeting of the current CBN governor. You know, it's due for either a renewal or he might just rotate out and another person is coming in. So if he rotates out, this will be his parting gift to the market. You know, but back to the substance. So we are seeing a 50 basis point reduction in the MPR. This, in our view, would not have as much impact, you know, on macroeconomic indicators and even the markets. And this is the way to contextualize it. Theoretically, when you reduce interest rate, what you're trying to do is to stimulate growth. You know, growth. And how you're doing that is by, you know, by more or less loosening, you know, monetary policy so that there's more money in the system, right? Corporates can borrow at a lower interest rate. When they borrow at a lower interest rate, they can improve their productivity. When their productivity improves, they can employ more people, reduce unemployment. You know, when they reduce unemployment for an economy such as Nigeria, what that does is that it brings more money to the pockets of people. People can spend more. When they're able to spend more, you know, Nigeria's GDP, for example, is driven by consumption expenditure, accounting for about 70%. What that does invariably is to grow your economy. But in this sense, what we've seen over the years, I mean, even before we enter into the, I mean, we experienced the price shock of 2014, is that the monetary policy rate, which is supposed to be a benchmark interest rate, that all other rates in the market, lending rate, savings rate, you know, discount rate on treasury bills or OMO, or even yields on sovereign bonds or other corporate bonds are supposed to, you know, consider, because it's assumed the risk-free rate in the real sense of it. It has not really been guiding in terms of how banks want to, you know, charge their interest rate. For example, if interest rate goes higher, what you see is that, I mean, the MPR goes higher, what you see is that the banks immediately reprice their, you know, their loan assets, you know, so customers are paying higher. But that does not happen, you know, if the flip is what we have, where in this case, MPR has been reduced. I can assure you that none of the banks will necessarily reprice their lending rates downwards. You know, that's on one hand. On the other hand, we are looking at impact. Before this was done, monetary policy rates stayed at 14%, but we had discount rate on treasury bills and OMO, I mean, on the average, reading about 12.7%. 12.7% gives you an effective yield of about 13.6%. Now, we see MPR at 13.5%, but before then, market rate is already at 13.6%. So there's no difference, really. So it means that whether the MPC reduce MPR or not would not necessarily matter in terms of how investors are pricing the yield. You remember, post-elections, we've seen more inflow into the fixed income market. That has driven down the yields, and we expect that to even continue, even without this decision. Now, so in terms of magnitude, we're not saying that, we are not expecting that this would have any major impact on lending. In fact, if the MPC had reduced MPR by 400 basis points to, say, 10%, it won't necessarily spur lending. Because again, the banks are looking at so many other issues, structural bottlenecks, you know, the vulnerabilities that we have within the macroeconomic space are some of the constraints that the banks are pricing into the lending rates. And that is why for corporates that have been able to distinguish themselves, you know, they tend to be able to borrow at a much more lower interest rate, which is why we have prime lending. So a corporate like such as Nestle or Nigerian Breweries or Guinness may be able to approach the market and still be able to enjoy an interest rate, you know, lending. I mean, from some of the banks, they may still be able to enjoy an interest rate that is not significantly higher than 17, 18%. But that is not what you have in terms of individual. You have rates even hitting up to 30%. And that won't necessarily change because MPR is now down to 13.5%.
Another worry, some are saying that this might even reinforce pressure on the Naira. You don't see that happening?
Absolutely. But, you know, I mean, this is the context. So when this news broke, you know, we sent out a note, you know, to those who are on our mailing platform. And what we said is that we think what the MPC is trying to do is to go back to convention. In the real sense, nothing has really changed. The cost of policy tightening is still on because there are more contending issues that the central bank has to deal with. Again, in the last 2 years, we've seen situations where the Monetary Policy Committee is going in this direction and the central bank is going in the other direction. How do I mean? So if the Monetary Policy Committee is signaling tightening, and you're seeing a situation where, you know, maybe by the action or inaction of the central bank, you're seeing the other side. You know, you're not really seeing a much of synergy. So what you're seeing right now is that, again, the central bank is still trying to, you know, attract more capital flows into the country. And to that extent, even though we have seen a slowdown in policy normalization in systemic central banks, you know, we still have our own peculiar risk that most investors want to consider when they're coming into Nigeria. So central bank will not give up on that mandate for exchange rate stability and price stability. Any further contraction in market rate, you know, I am very specific about market rate because, again, MPR has since lost its potency over the last 2 years to guide market rate. So what we expect is that market rate will not necessarily respond, you know, because like I said earlier, what you will expect naturally, even if MPR has stayed at 14%, because of attraction and more demand for fixed income securities, yields will have dropped naturally. So that is, again, the path that we think will continue. And MPR reduction is not significantly going to have impact. But I make bold to say that the MPC and the CBN are very serious about exchange rate and price stability. So let's not start expecting that this is the new policy signal and then the easing cycle is about to start. Not just yet.
Okay. I have to round up this down. Yeah. He also said the economy is ripe for rebasing, talking about the last time it was, I think that was 2010. If we look at the figures that we have. Really, is that what effect will that have? Do we really need to do that? And where do we go from here as we round up this?
Well, again, rebasing is a normal statistical, you know, exercise that central banks are supposed to, I mean, the statistical body, in this case MBS, are supposed to carry it out from time to time, just to show the true reflection of the growth numbers that you're seeing. Because again, you hear analysts talk about base effect when maybe inflation price is out or, you know, GDP is out. Because again, the base determines how much you can grow. If I grew my economy by 10% the last fiscal year, again, there's a limit to how much I can grow. Remember, before you can grow, so let's say your GDP was 122 trillion, right? For you to grow by another 10%, you need to build up at least 12.2 trillion on top of that, you know. So base effect always have, you know, consequences, and that's why economies are always shifting bases. But going from here, let's not be distracted, right? This is an economy that needs a lot of foreign capital, you know. On the FPI side, we're able to attract them because of the high yield. And we don't think the central bank is going to give up that. But to stimulate growth, what we need to do much more, and very critically too, is that the government needs to focus on some of the structural bottlenecks that we have that are preventing investment. Indeed, direct investment, foreign direct investment is what can take us out of this low-paced growth that we're experiencing.
Roberto Omotunde, thank you very much for your time. Head Research with AfriInvest, giving insights into all of this.
Thank you.
Thank you so much for sharing your afternoon with us.
Thank you.